Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us for this segment, we have Gerard Smith, Head of Product, Digital Assets, and Carbon at Nasdaq Marketplace Technology, as well as Tomas, Thyblad, Head of ESG Solutions at Nasdaq European Markets, to discuss carbon markets and credits. Gentlemen, it's great to have you with us. Welcome to Trade Talks.
Thank you, Jill.
Very much.
All right, you got it. And Gerard, let me ask you this first. Can you each introduce yourselves and tell us about your roles at Nasdaq?
Yeah, I'm head of product for market technology, specifically dealing with digital assets and carbon. And so one of the things that we're doing at the moment within market technology is building solutions for carbon markets. So specifically what we're working on at the moment is to build carbon registry technology. We already have carbon trading technology. So the idea is that we will be able to put those together and be able to power marketplaces for evolving carbon voluntary markets.
And Tomas, tell us about your role at Nasdaq.
Yes, absolutely. I'm head of ESG Solutions within European markets, based in Stockholm. And within this role, I have been focused more and more on the carbon markets. And in that focus, I have worked very much with our what we did the majority investment in 2 years ago, the carbon removal crediting platform Pure Earth. So that has been my very much focus during the last 2 years.
And Tomas, what were some of your key takeaways coming off of Climate Week, New York City?
I think I have 4 main takeaways from that week. First of all, you can say the voluntary carbon market has had a quite challenging year. It has been a lot of discussion about the quality of the type of credits, etc., and that has put that has made it a bit challenging, I must say. Despite that. And secondly, then, despite that, I think the CDR space, the carbon removal space, has done quite well. We had a lot of different CDR events during this week with a huge interest. So that is very, very very promising, and also that the stakeholders start to differentiate between the more traditional carbon credits and these carbon removals. Thirdly, I think another challenge we have is that we need more clarity on the claim side, i.e. the corporate. How should the corporate use the carbon credits? What are they fine to claim, etc.? And we need more clarity on that side in order to actually get the full, unlock the full potential from the corporate side. And then lastly, one reflection as well that has been quite a lot of discussion about is that previously we have focused very much on the mitigation activities, etc. I think we are shifting over now and also focus quite a lot on adaptation. And that means that we will have to funnel and channel more and more financial flows, not only to mitigation activities, but also to adaptation activities.
And Tomas, looking forward to COP28 in a few months, what are your expectations for this massive global event, and what do you think are the agenda priorities?
I think the agenda priorities if we focus on the carbon markets, I think it's one, of course, Article 6 in the Paris Agreement. And I think the relation in terms of the transactions between countries, there are quite a lot of different topics or different details to straighten out etc., in order to unlock that potential in the market. That's going to be a lot of discussion around. I think also, which is very interesting for the VCM market, the voluntary carbon market, is that it's going to be a lot of discussion about the link between Article 6 and the VCM. How should that actually be handled? How should it be treated? We need more clarity around that. And then lastly, in terms of the carbon markets, I think it's we're going to continue to see this trend with the differentiation between the different types of credits, i.e. the CDRs, the more permanent CDRs will continue to be treated as a different type of instrument compared to the more traditional carbon credits. Both will be complementary tools to the real abatements, to the real reductions, and that's the way it should be. But still, we hopefully at least, and I think so, we'll have a clearer differentiation between the different tools. And then on a more general perspective, I think it's going to be a more pressure on the developed countries to actually step up and to become more aggressive and more there, have more stricter and tougher NDCs and climate goals. Actually, last round we had the less developed countries to step up and be more ambitious. Now it's time for the more developed countries. And lastly, of course, it's going to be a big focus on whether this is the time we focus on the phase out of the fossil fuel. That's going to be a huge focus on that, how strict, how harsh the language will be.
And Gerard, from an infrastructure and technology standpoint, what trends do you foresee in carbon removal markets over the next 12 to 24 months?
Well, John, that's a really topical question and one that we're currently looking into. In fact, we just launched a survey with our partners at Value Exchange to look exactly at these kind of questions. So we're trying to understand what the carbon market trends will be over the coming years, what are the pain points currently within the market, and what do stakeholders see as really the drivers for growth over the next few years to free up liquidity in those markets. But from my point of view, I think firstly, we'll see a greater role played by financial market into infrastructures. These are the type of actors that know how to structure markets, know how to make them efficient, know how to launch new innovative products and how to bring liquidity and transparency. So that's the first thing. And secondly, I think that the markets will start to become more institutionalized. And that means that the intermediaries will start to play a bigger role. So I'm talking about firms like brokers, custodian banks, for example, and that will be an important step since it's these players that take pain away from corporate buyers by offering the corporate analysis, ease of access, efficient sourcing of the carbon credits, and just generally simplification around the whole purchasing of carbon credits and then retiring them.
And finally, Gerard, how does FMI modernization factor into support for new assets like carbon credits?
Well, we know again from a recent survey of the post-trade industry that there's a huge problem with legacy infrastructure within financial market infrastructures and more broadly within capital markets. So when a firm's budget is mostly spent on maintaining legacy systems, keeping the lights on, regulatory change, there may be little room for firms to adopt new asset classes and more generally to seek out growth opportunities.
All right, Gerard, Tomas, we appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thank you.